Hey folks, it's Terry Gardner from CJ Lawrence. It's Thursday, the 24th of October. We're kind of a third of the way through earnings season for the third quarter of 24. So I thought we'd do a quick video today, kind of take stock on where we are, but also to take a step back because a lot has happened in the last few weeks. Let's take a step back, see what the CJ Lawrence Market Monitor is telling us, and then take a look at valuations because there's a lot of chatter in the market today and in the financial media about the market being expensive or priced just right. So let's take a look at that. But first, let's revisit the old trusty CJ Lawrence Market Monitor. I mean, what is it? The Market Monitor was created by my mentor and our mentor here at CJ Lawrence, Jim Moltz, back in the 1980s. And it was not necessarily to create a timing tool, but it was to put together a series of metrics that would help investors gauge whether the timing was good to invest in equities, particularly in relation to fixed income. And so this Market Monitor was created, which contained 6 components, all having fundamental interest rate or technical and breadth components to them. And the sum of the monitor components gives us a reading, which gives us some relative feel for where we are in the cycle and the attractiveness of stocks. I was just looking back at some past monitor readings. I mean, this one goes back all the way to 1988. So this model has been around for a long time. It's been obviously time tested and has had an excellent track record over time of not necessarily timing entry and exit points, but in calibrating the appropriateness of a heavy or lighter equity allocation. And so where's the monitor today? The monitor has moved from kind of a neutral stance to a positive stance, and a solid positive stance. So out of a reading of 6, it's at a positive 3. And what has moved the monitor from more of a neutral stance over the last 30 to 60 days has clearly been the move in interest rates. When the Fed finally reduced rates at the short end of the yield curve by 50 basis points, that flipped the interest rate sensitive models over from being in kind of a neutral negative stance where rates were going up to one where rates are now going down, and that turned the sentiment in those models in a positive direction. So when you weigh them all out, the fundamental components are mixed. The interest rate models are now positive because it looks like the direction of interest rates is negative, or rates are going down. And then the breadth and the technical measures within the model and the monitor are positive because we've seen stocks reacting to that backdrop and have done well. We're up close to 22% year to date on the S&P 500. That's really a strong year in any year if it ended today. So the Market Monitor is telling us to stay the course. The backdrop, when you take a step back from all the machinations that are happening, all the conversations that are happening in the market on a day-to-day and week-to-week basis, the Market Monitor is telling us that the coast is pretty clear. And then another model that we like to look at in terms of valuations is the Rule of 20. You've heard us talk about the rule in the past, and the Rule of 20 has been elevated really for the last 2 to 3 years. Okay, so the Rule of 20 is taking the market multiple, the price earnings ratio on the stock market using the S&P 500, and adding the rate of inflation. And when you have added those two together over the past 50, 60 years, for some magical reason, the result is around 20. We have been, for the past 3 years, elevated because we've had a very high level of inflation and we have not had a corresponding dip in the price earnings multiple on the S&P 500. Essentially, the markets kind of looked through the inflation and said, look, inflation will come down, and it has. So where's the ratio today? You know, if you take a look and say, well, I think the market multiple on next year's earnings is about 22 times, and throw 3% inflation on there, you got 25 as a Rule of 20 reading, so 5 points ahead of where that average is. But it's been 23, 24, 26, 25 for the last couple of years. So it's high, but it's been high, and it really hasn't held back stocks. And when I looked at the past couple of years for valuations, if you take a look at price earnings multiples going back 30, 40, 50, 60 years, you will find much lower levels of multiples on earnings in previous decades. But if you look at the last 10 years or so, PE multiples have been relatively high. My theory is that that's because information flow is such more prevalent today than it ever has been, that investors can get comfortable with looking ahead 12 months or 24 months to value stocks. In past decades, you often used to receive your information on earnings and cash flow multiples in physical paper. And it was all kind of historical based, right? So if you looked at the 50s, 60s, 70s, those multiples were based more on historic trailing 12-month earnings per share. And today we're looking out a little bit further, into the future. And so investors have that comfort level with trading up at higher multiples. If I just look at the last couple of years, kind of tough with COVID being in the 2020, 2021 period where earnings were depressed and prices hung in there. So the multiples were kind of high. But even in 2018, 2019, the forward multiple on the S&P 500 was 22.3. In 20, it went to 20.2. And these are 4-quarter forward multiples. And I'm just throwing out some numbers here just to give you a feel. We're at 22 times next 4-quarter forward earnings. So we were at 20 and a half, 18.5 in 2022, which was a dip. 19.6 is 23, and so we're at 22. So it's a little elevated, but we're not at 30, 31, 32. I mean, the NASDAQ traded at 36 times earnings when the internet bubble was inflating. So I don't think we're at those egregious levels. So I thought it was important, as I mentioned, we're in the early stages of earnings season, and I'll leave you with this. We've got about 30% of the companies in the S&P 500 having had reported. And I would say, the results are somewhat mixed. About 78% are posting kind of positive surprises, which is a little bit lower than we've seen in past quarters. And it looks like the quarter's going to come in with about 2.5% growth. That's where it's coming in now versus the same quarter last year. It's a little bit below where we thought we'd be. But where are the outliers? Because there's certainly some that have fallen short, but the outliers are again in technology, right? So leadership could return to technology. Keep an eye on that because they are delivering, technology companies, whether it's semis, software, they're delivering on earnings, and their forecasts are going up for next year. So markets rotate, but let's stay focused on the innovators as we look out into next year. If you got any questions about the monitor or valuations or any of this, please give me a ring. We'll come back to you once earnings season is complete and reported, and kind of do a dissection of where the growth came in and what the outlook is for next year. But in the meantime, feel free to give me a ring, 212-888-6403, or shoot me an email at tgardner@cjlawrence.com. Thank you and have a great night.